Welcome to Beyond the Algo, the podcast where we strip away the noise and talk real trading, past, present, and what's coming next. If you're here, you already know the game never sleeps. Today's episode is one I've been itching to record: the future of trading, AI, algos, and beyond. Grab your coffee, pull up your charts, and let's walk through what's already here, what's on the cusp, and, most importantly, how you can stay ahead without getting run over by the machines. Let's start with a confession. The first time I saw an algorithm execute a perfect VWAP slice across 1 million shares in under 4 seconds, I felt, well, obsolete. That was 2009. I was still proud of splitting a tick by hand on a volatile biotech name. The machine didn't gloat, it just printed money and moved on. That moment taught me the future isn't about fighting the tech, it's about learning to dance with it. So where are we right now? High-frequency trading, or HFT, already accounts for roughly half of U.S. equity volume. Firms like Citadel Securities, Virtu, Jane Street, they're not just fast, they're surgically precise. They co-locate servers inside the exchange matching engines, measure latency in microseconds, and arbitrage tiny discrepancies most humans can't even see. But here's the thing, speed is table stakes. The next frontier isn't faster, it's smarter. Enter artificial intelligence. Not the sci-fi version with glowing red eyes, but practical, data-hungry models that learn from every tick, every headline, every shift in the VIX. I run a small hybrid shop now, part discretionary, part systematic, and we feed terabytes of order book snapshots, satellite imagery of crop yields, even shipping container GPS pings into a stack of transformer models. The output? A probability surface that updates in real time. Given the current microstructure, the likelihood this stock gaps up 3% at the open is 68%. That's not a crystal ball, that's edge. Now, I know what some of you are thinking: Isabel, isn't this just black box gambling? Fair question. Early quant funds in the 90s treated models like oracles, until long-term capital management blew up and reminded everyone that PhDs don't trump leverage. The lesson? Garbage in, garbage out. AI is only as good as the data you curate and the risk controls you enforce. I still manually override the model at least once a week. Last month it wanted to short a mid-cap semiconductor into earnings because sentiment scraped from Reddit was bearish. I dug in, saw the company had just locked a massive defense contract buried in an SEC footnote, and flipped the position long. We banked 14% in 2 days. Machines are brilliant pattern matchers, humans are still better at context. Let's talk execution algorithms, because this is where retail traders can actually level the playing field. Remember when market order was your only choice and you got front-run by every desk on the street? Today, brokers like Interactive Brokers or Alpaca give you TWAP, VWAP, POV, even iceberg and sniper strategies baked into the API. Here's a pro tip from the trenches: never send a plain market order on a thin name after 3:55 p.m. Eastern Standard Time. Instead, set a POV algo at 8% of volume with a 2% participation cap and a dark pool preference. You'll slip less, print cleaner, and avoid lighting up the tape for the HFT wolves. I've seen retail accounts cut effective spread costs by 60% just by switching from buy at market to a smart router. But the real revolution is happening in alternative data. When I started, edge meant calling your buddy at a sell-side desk. Now it's pinging weather satellites to predict corn futures or scraping Joby Aviation's FAA certification docket for clues on eVTOL launch timelines. One of my favorite feeds? Credit card transaction aggregates. When discretionary spending ticks up in a zip code 2 weeks before a retailer reports same-store sales, that's alpha, pure and simple. The catch: you need infrastructure. Cloud bills add up, and cleaning messy datasets is 80% of the battle. Start small. Pick one alt dataset, maybe satellite parking lot fullness for big box chains, and backtest ruthlessly. If it survives 3 regime shifts, layer it in. I want to pause here and bring in a voice far wiser than mine. Tudor Jones once said, "The secret to being successful from a trading perspective is to have an indefatigable and an undying curiosity about how things work." That was 1987. Swap things for models, and it's still gospel. Curiosity is your moat. The kid who reverse engineers a Pine script indicator today will be the PM running a $500 million pod tomorrow. Let's look 5 years out. What's coming? First, reinforcement learning agents that don't just predict price, they optimize the entire PL surface, balancing slippage, adverse selection, and gamma exposure in real time. Imagine an RL trader that learns your personal risk tolerance the way Netflix learns your taste in movies. It places the order, adjusts on the fly, and debriefs you afterward. I routed 60% through lit venues because dark liquidity dried up at 10-12 a.m. Here's the counterfactual. Second, decentralized prediction markets on blockchain. Polymarket already showed us during the 2024 election that crowd wisdom plus skin in the game can outperform polls. Picture that scaling to earnings binaries, Fed rate paths. Even micro events like will Tesla deliver greater than 500K vehicles in Q3? Liquidity will be fragmented, but arbitrage bots will stitch it together. As a trader, you'll subscribe to Oracle feeds the way you subscribe to Bloomberg today. Third, explainable AI regulations. Europe's AI Act is forcing model cards and audit trails. That sounds bureaucratic, but it's a gift. When your algo gets questioned by compliance, you'll hand over a human-readable decision tree instead of shrugging. Build that muscle now. Document every feature, every hyperparameter, every out-of-sample test. Your future self will thank you. Now, a word on psychology, because no amount of tech fixes a broken trader. I still keep a physical journal, yes. Pen and paper, next to my monitors. Every losing trade gets a one-line postmortem, overrode model on emotion, cost 42 BPS. AI can't cure tilt. Only you can. Set circuit breakers. If drawdown hits 2% intraday, the system auto-flattens and locks me out for 30 minutes. Harsh? Yes. Profitable? Absolutely. Let's zoom out to the macro canvas. Central banks are waking up to algorithmic liquidity. The Fed's standing repo facility, the ECB's TLTROs, they're blunt tools compared to what's coming. Picture a world where monetary policy is transmitted via smart contracts. The Fed credits primary dealers' wallets at 5:30 p.m. sharp if overnight SOFR breaches a band. Markets will front-run the code, not the press conference. Your edge will be reading the source, not the headline. Another quote, this one from Jesse Livermore, the original tape reader, "There is nothing new in Wall Street." There can't be, because speculation is as old as the hills. AI isn't new, it's just the latest incarnation of human greed and fear, digitized. The patterns repeat, only the resolution increases. Practical homework before we wrap. 3 things you can do this week. Open a paper account and code a simple mean reversion strategy in Python. Use pandas for signals, CCXT for execution. Run it on 15-minute cust pair data. Tweak one parameter daily and watch sharp dance. Subscribe to one alternative dataset under $100 per month. Koyfin has satellite imagery, Quandl has freight rates. Ingest, clean, correlate. Read the white paper for Nasdaq's new AI-powered market surveillance engine. It's public. Understand how the exchange is watching you. Forewarned is forearmed. We're already living in the future, most people just haven't noticed. The traders who thrive won't be the ones with the biggest servers, they'll be the ones who treat technology as a co-pilot. Not a replacement. Stay curious, stay paranoid, and always, always, manage the downside. If you found this useful, share it with one friend who still thinks algo is a typo. Drop your questions in the comments down below, I read every single one. That's our deep dive into the future of trading, AI, algos, and beyond, 5 minutes of signal in a world drowning in noise. If this episode sparked something, do 3 things for me. Hit subscribe so you never miss the next edge, leave a quick rating on YouTube, Spotify, or Amazon Music. It's the best way to keep the lights on, and share it with one trader who still thinks neural net is a tennis term. I'm Isabel De Palma, signing off from Beyond the Algo. Until next week, trade small, learn fast, and always protect the downside. This episode was produced by Bellsforex AudioWorks, precision engineering for financial storytelling. Sound design, mixing, and that ticker heartbeat you hear? All Bellsforex. Visit bellsforex.com/audioworks to bring studio-grade polish to your own show. See you on the tape.